Hi, welcome to today's webinar where we will be talking about retirement income solutions in South Africa. In particular, we'll be talking about how to navigate this vast landscape. As introduction, I wanted to give an example which illustrates the importance of perspectives when navigating. So let's look at the Richard structure in Mauritania in the Sahara Desert, West Africa. Here is a picture of that structure. Can you see it? From here, it looks like just another bleak desert landscape. It's only when you zoom out and look at it from the sky, or even better from space, that you can see its beauty. And only then can you see why it's called the Eye of the Sahara. Goes to show how important perspectives are. And similar goes for when you consider the right retirement income solution. To give you some interesting perspectives and insights, let's consider some of the main findings of our Just Retirement Insights survey from 2024. Just Retirement Insights is a tracking study powered by Just to better understand the South African retirement market. To date, we've concluded 6 of these, and here we look at the main findings from a 2024 study, where we had 395 respondents. Firstly, let's look at how respondents felt about their capacity for financial loss. And as you can see, they had a very low capacity for loss, with more than 80% saying they can only afford to lose 0 to 10%, so in that green zone. In other words, for them, financial loss or the worry about that is just very high on their agenda. When asked how they want to use their retirement savings, most still said that they will use that to generate an income to pay for their expenses for the rest of their lives. Then to pay for long-term care or to pay off debt or other things. So that just shows that consistently such a dependable lifetime income remains key. When we ask about their preferences regarding retirement income, the key needs have remained largely static over time. The first and foremost, with now being the top scorer for a few years running, being that my retirement income must continue for as long as I live. Then that it must cover frail care and medical bills, must keep up with inflation, which has retaken the third position, and then only further down showing where you'll see that they would like flexibility in that retirement income. We also asked about their perspectives about their own life expectancy. And what we're showing here is just how respondents answered to this question. You'll see the different blobs or the different people and how they said that they think that how long they would live on average. And we've also plotted that by age. So interestingly, the average was fairly in line with statistics, but as you can see, there was a wide distribution of answers. And this area of the graph being quite problematic. So these are respondents who consistently underestimated their life expectancy. And this is quite telling, given that they were in the age band from 60 to 70, where often you have to make literally lifelong decisions about what to do with your retirement savings to give you the right retirement income for the rest of your life. With that was quite interesting that they also thought on average that they have above average health, in other words, that they were healthy. Finally, the study again showed that inflation remained a key factor for respondents, with 84% saying that their retirement income should keep pace with inflation every year. Let us now look at the retirement income landscape in South Africa. Firstly, to set the scene and maybe as a bit of a reminder, the main risks in retirement are longevity, inflation, and investment. When planning for retirement income, these risks should all be carefully and perfectly considered, but we find that many do not do that. So let's look at longevity, or differently put, the probability of survival first. Now, what we put down here are two typical probability curves. One for male age 65 on the left-hand side, and one for females age 65 on the right-hand side. And maybe just a quick run through those and what these are. These show the probability of being alive at a point over time. Therefore, starting with 100% on the left-hand side, so at that age, and over time, that probability going down as people die. As you would expect, the rate of deaths increase over time as mortality rates increase, with a flattening off towards the end as rates go up, but there are just fewer people alive. From that, you can then read off different probability points. And what we've shown here are 4 points. The first, at which point do we expect 3/4 of people to be alive? Then 50% of people, and which is also called the life expectancy, which you can see for age 65 is 82 years of age. Then 25% probability, and finally, up to which point do you expect at least 10% of people to be alive. Similar goes for females on the right-hand side, although you will already notice that the curve is elongated, and that's really just because female mortality rates are lower on average, and therefore their life expectancies are higher. Here you will note similar numbers, but to highlight to age 87 as the average life expectancy for a 65-year-old female, and then the green box, 10% probability of survival up to the age of 100. And that is why best advice often dictates that one should look at a period up to that 10% probability level, because that is the point of time up until which you expect 10% of people to be alive. Therefore, considering anything shorter than that is not necessarily right. To give it some perspective, to think about life expectancy only is to say that you only look at half of people's financial situation. And the reason I say that is that literally you'd expect 50% of people to live beyond that point. And that's why common advice is to say, consider a period up to age 95 for men and age 100 for females. Now, if we go and look at these probabilities of survival and overlay them over graphs which show how long you'd expect income to remain for different levels of drawdown. So what we have here is 4 different periods horizontally, so different durations, and different drawdown levels, which we show vertically. You would, of course, expect that the higher you draw down, so further up these curves, the shorter you'd expect that income to remain sustainable. If you now overlay these probabilities of survival, this is quite telling. You may notice here that the orange bar, the 50% point life expectancy, which I mentioned was 82 years old for a 65-year-old male, that takes you up to 17 years. And then finally, that 30-year point, so that 10% survival probability. And that's really what you want to be aiming for. And in a nutshell, that is why safe drawdown rates are considered to be below 5% for someone aged 65. But looking at this in a more detailed way and using similar thinking, and the CISA working group considered various longevity factors and scenarios to run some complex calculations, and they then derived this table of safe drawdown rates. These were published by the FSCA in a draft paper in the context of default living annuities. And as you can see, they range from 4% to 8%, depending on age and sex. Now, in studies we have been doing since 2019, we then also considered life annuity rates for these different ages and sexes, in addition to the recommended drawdown rates. They're shown on the right-hand side of the table. And as you can see, the life annuity rates are materially higher than the safe drawdown rates on the left. Simply put, the reason for this is that a life annuity can be priced with average life expectancy in mind, whereas a living annuity needs to provide income for someone living longer than that, because they are essentially self-insured, and therefore the equivalent drawdown rates are lower. Using this data, we plotted people on what we call an income sustainability map, where we plotted age on the horizontal axis and then drawdown levels on the vertical axis. This map then shows the distribution of living annuitants by those two dimensions. We then overlaid a blue line, which is this safe drawdown rate, what I mentioned just now from the FSCA, as well as a coral line, which shows the equivalent life annuity rates at these different ages. And the three zones which results from this map with the two lines, we ultimately call an income sustainability map, which provides a quick litmus test of your income sustainability for any individual or book of living annuitants. We have studied more than 30,000 lives in this way. And for them, we have created these income sustainability maps. What I show here is just a visual representation of what the results look like, with all these various dots showing where the people are within the different zones on this income sustainability map. And here is an actual example of what a typical scatter plot, which we call this income sustainability map, would look like, with each gray dot representing an actual real life. And as I mentioned, age plotted horizontally and drawdown level vertically. Now, looking at these three zones, we then said the bottom one, which we call the safe zone, is where an individual is drawing less than the safe drawdown rate and therefore has a sustainable drawdown strategy. Zone 2 in the middle is the risky zone, where individuals are drawing between the safe drawdown rate and the life annuity rate, which could be unsustainable. And finally, the danger zone at the top, where they're drawing above the guaranteed annuity rate, which is unsustainable. But the problem without a solution remains a problem. So we mapped appropriate retirement income solutions for each of these zones. In the safe zone, a pure living annuity offers flexibility, but your money could still run out. In the risky zone, a blended annuity vastly improves the income sustainability without the need of reducing your income. And finally, in the danger zone, a life annuity can eliminate the risk of running out of money. In terms of our findings overall, as a quick overview, these were as follows. As you can see, 32% of people sitting in that safe zone, with 34% respectively in each of the danger and risky zones, thereby meaning that roughly 2/3 of lives drawing down at unsustainable rates. For the sample, the average drawdown was around 8.5% per annum, whereas the equivalent safe drawdown rate should have been 5.3%. That would result, on average, in an income shortfall of more than 15 years. Ultimately, the optimal retirement income strategy thus depends on which zone you're currently in. And to do this, 3 basic steps are required. Which rate of income do you need? Mapping this compared to those two lines, so the safe drawdown rate and the life annuity rate. And then finally, helping people to choose the optimal retirement income strategy with reference to those 3 zones. Looking at retirement income perspectives and how these manifest in behaviors. This slide presents different scenarios comparing the distribution of living annuities to life annuities. The first scenario, shown here, reflects the split between life and living annuities if you were to apply logic, and in this case, what we've been showing in the previous slides, where we saw that 68% of living annuitants are drawing down above sustainable rates, and thus you should argue that these should really be in some form of life annuity. However, what we see in practice looks quite different. So I've shown here 3 different time periods, and these are all based on rough estimates from the market. Firstly, for the period from around 2000 to 2021, where we have seen approximately 90% of monies at retirement going into living annuities and only 10% going into life annuities. From 2022 to mid-2024, some reversion to something more like what you would expect, with 65% going into pure living annuities and 35% going to life annuities. But then, since mid-2024, a reversion to what we think now looks more like a 80-20 split, which already then indicates that some of the experience we saw from 2022 to mid of this year was rather opportunistic and not from a fundamental point of view. Considering other perspectives in the retirement income market, a material recent trend is around the reduction in annuity rates, which has led to many more opting for a pure living annuity. So let's unpack this in a little bit more detail. To give some perspective, what we are looking at, here is the annuity rate over time from 1 January 2018 until now for a joint male age 65. But before we delve deeper, let's make sure we're on the same page. The annuity rate is really just the amount of income expressed as a percentage that you can get per year in return for the lump sum that you invest into that life annuity. So, for example, if you have a lump sum of 1 million Rand to invest and you could get 60,000 Rands of income per year, that equates to a 6% annuity rate. So on this graph, you'll note a few things if you move from 1 January 2018 up until today. And this is that the rates have varied roughly between 5.4% as at January 2018 up to 7.4% at its peak in October 2020, and then downwards to current levels, which is just a bit higher at 5.5%. As you may know or would expect, these rates are highly correlated with bond yields, which have been fairly high over this period and is actually still quite high. But to give a better perspective, we've overlaid that safe drawdown rate for this case an example, which is assumed to be 4%. And you will see that these annuity rates are still much higher. In fact, over this period, it was 50% higher on average. And bringing this back to our income sustainability maps, only 32% of lives were in this zone, yet 65 to 95 to 90% of purchases went into pure living annuities. Here's another perspective to consider given the current market environment. The income a retiree can secure at any point in time is what really matters. This is what determines their standard of living. Income is determined by the combination of the market value of retirement savings and the annuity rate at that point, not the annuity rate alone. Recovering markets have increased the value of retirement savings, and long-term interest rates remain quite high, even though they've come off their highest point in the middle of this year. So to put current market conditions into perspective, have a look at how the different components have moved over time. The gray line is the market value of a balanced portfolio. The coral line is the Julie annuity rate, which changes to more or less offset the change in the market value of the balanced portfolio. Finally, the green line is the combination of those. It is the effective guaranteed lifetime income that a client can purchase. And as you can see, this is still quite a bit higher than the beginning of this period, which was from 1 January 2013. And two factors, to summarize, contributed to that: strong growth in balanced funds and long-term interest rates, which are still high, resulting in good annuity rates. Now that we have looked at different retirement income market considerations, let's home in on guaranteed life annuities. And the key question here is which one to choose. When considering these, you need to weigh up your choices based on needs, desires, and how much you've saved. Because, for example, a level annuity is considered cheap because it will offer a high starting income. And on that basis, it seems the best choice. Yet, it doesn't protect purchasing power. And given this long time horizon that we need to consider, and the fact that we have relatively high inflation rates in South Africa, it is key that you look at the level of inflation protection. On the other hand, considering that alone, everyone should be buying an inflation-linked annuity. However, those are expensive, or differently put, they have the lowest starting incomes. So one really needs to consider at least both these aspects. Looking at this, you may say the sweet spot for choices generally fall, or should fall, between fixed escalating and with profit annuities. And here is where an interesting risk-reward dilemma has unfolded, which I will tell you more about later. No discussion in the current retirement income marketplace is complete, however, without covering hybrid or blended living annuities. These types of products literally completes the picture as it covers all options in between, which often is the optimal retirement income strategy. In a nutshell, it offers the best of both, combining a living and life annuity in one investment vehicle. A different way to see the benefit of blending is with reference to which income rate can sustainably withdrawn. Consider two examples. Firstly, with no blending, in other words 100% in a living annuity. In this case, for example, 4% can be safely withdrawn. Now let's look at a case where we've blended 50%. The safe drawdown on the pure living annuity side remains at 4%. However, the life annuity component provides an income which is higher, in this case, for example, a 6% annuity rate. In combination, these two then provide a safe combined rate of 5% per year, which is 25% more than what you would have been able to sustainably withdraw from the pure living annuity. You can think about inflation a bit like rust on a car. At first, you might not notice it, but over time it spreads, and before you realize it, the damage is more extensive than you anticipated. Just like rust, inflation can creep up on you. So it's worthwhile thinking about it carefully. So what do we know about inflation in the South African context? Inflation targeting is still relatively young and was only introduced in the early 2000s to try keep inflation under control. Even though it's been quite successful, I think it's fair to say that it doesn't always work as expected. Often people say that long-term South African inflation will be around 5%, but it has been below 5% only 10 times since inflation targeting was introduced. Inflation was significantly higher in the years before inflation targeting, and since then it has also pushed beyond 5% on a few occasions. Around 2002, which was the internet bubble, Then 2007, 8 and 9, which was the global financial crisis. And then more recently, with pressure past COVID, but also driven by market uncertainty and global wars. So how does inflation look like in Rand terms? We wanted to show what the value of 10,000 Rand now would look like over time if you were to take different levels of inflation into account. So what we show here is on the 3% inflation line, that green line at the top, in 30 years' time, that would be worth 4,000 rands, roughly speaking, in today's term. Looking at 6% inflation, that would result in something that's worth around 1,700 rand in 30 years' time. And then finally, looking at perhaps a more extreme scenario, if inflation were to be 9% per year continuously for this period, then your 10,000 Rand today would only be worth around 750 Rand in 30 years' time, if measured in today's terms. There's also some fun to be had when looking at inflation. South African economist Johan Bielman created the Braaibroodjie Index as a means of measuring food inflation. Maybe just a fun way to say that there could also be different baskets to consider when you look at inflation. He posted on X that the price of a braaibroodjie hit an all-time high in April, and it pushed the overall price up by 4.3% compared to previously. Turning our focus now to with-profit annuities, or otherwise known as investment-linked lifetime income. I showed this previously with the different types of annuities, but now we're going to look at that last one where increases are driven by the underlying performance of a fund, which we smooth over time. And it wouldn't be a just presentation if we didn't look at with-profit annuities in more depth. So why do we feel that with-profit annuities remain such an important tool in the retirement income landscape in South Africa? We've spoken about the need to protect against inflation over time. Looking back first, we can see that with-profit annuities have literally done better over the long term. We show here the relative incomes from a with-profit annuity as opposed to an inflation-linked and a fixed escalating annuity. And the reasons we would have expected this and see it is that high equity balance funds are expected to outperform fixed interest portfolios in the long term. Smoothing reduces the risk of market dislocations, and therefore with-profit annuities have historically and are expected to continue to provide good value for money. So for with-profit annuities, let's look now at different options that are typical in the marketplace, which weigh up starting income versus future increase potential. And what we've put down are three typical options you see in the marketplace, ranging from lower starting income, but higher increase potential, to higher starting income with lowest increase potential. And as you can see, for these three, what we call calibrations, these aim at different levels of inflation protection, where if you were to expect reasonable returns from the underlying funds which drive these increases, you would see that then 100%, for example, 75% or 50% of that inflation levels being reached for increases. But they do offer different levels of starting incomes. So here, as you can see for the blue line, which we call the high grow option, you have the lowest starting income, but higher expected increases over time. Similarly, or inversely, for the green line, where you have the highest starting income, but lowest increases over time. And then finally, in the middle, stable grow, which gives a good balance of the two. But what we wanted to show here as well is that these three options give similar total income expectations up to life expectancy. So differently put, if you wanted to visualize it, you can think of the area underneath these three curves. And for example, the first one being that blue area, which you can already see is quite similarly sized to the coral area, or finally the green area. Important to note here though is this is all up to life expectancy. So if you were to live beyond that point, which you would expect in 50% of cases, then you could say it will be better to be in the higher increase options. But reality means you do need to consider affordability because that gives you the lowest starting income and you would have to live off those income to cover expenses. But there's a massive coral elephant in the room. Given the last few years, investment performance hasn't been great. And because of that, increases for with-profit annuities have not been that good. Plus, starting incomes have been less competitive compared to fixed escalating options, partially driven by high expected increases in the future, especially in the far future, from these with-profit annuities. So we did something about it. And we asked, is there a with-profit annuity option that matches this pensioner risk appetite better? Our new advanced feature is an innovative with-profit annuity feature offering 5 to 15% higher guaranteed starting income in exchange for capping future investment returns used in determining increases. These will be capped at an attractive 15% over the 6-year smoothing period. Within Julie, a client pays for this expectation in increases, whether it materializes or not. So with this advanced feature, the potential for that being capped is now exchanged by giving a higher starting income upfront. To illustrate this point, if we were to consider the two calibration options I showed earlier, so the blue, which was high grow, and the green, which was stable grow, under expected levels of increases, this would literally just mean a higher income for both of those. And this is if you would assume that smooth increases would not go beyond this capping level of 15%. Now let's compare standard or the normal just lifetime income, our with-profit annuity option, with this advanced feature. If you look at starting income, for example, you'll see that the advanced option here offers around a 10% higher increase. Now let's compare just lifetime income, our standard option, with this advanced feature in a few numbers to illustrate the point. So what we've got here are two columns where we show the standard Julie numbers as opposed to advanced. Starting with the beginning income, as you can see, the advanced feature for this case gives around a 10% higher starting income. Now looking at the different impacts that the option could have, and we've picked 3 future investment return scenarios for simplicity's sake, just to illustrate the point. Firstly, considering a worst case or a bad case scenario where increases are 0, and note that income can never reduce, that of course would be the same across both products. Then looking at some level of mid-range expected investment returns, for example, 11% nominal. So that's something like saying 6% inflation plus 5% real. Both of these would give exactly the same increase. It's only when investment returns go beyond 15% on the smooth 6-year basis that the difference becomes tangible. And there, the advanced option would cap that increase at 7.97%, whereas the standard option would go beyond. Now, looking at different inflation scenario, this gives you a good indication of the relative protection levels offered by these different increase types. So we've looked at 3 inflation scenarios, 3 to 6%, so let's call it that South African Reserve Bank targeted range, 6 to 12%, so if inflation were to double, And then finally, a blowout inflation scenario where inflation is more than 12%. As a reminder, then also different levels of starting incomes. Firstly, fixed escalating 6%. Within that range of inflation increases over the long term, remember, so 30 plus years, that inflation protection would be very good. When inflation doubles, though, it provides very little or no protection, though. And as you can see, the purchasing power of that income will then be materially reduced compared to had you had proper inflation protection. And finally, for blowout inflation, no protection. Considering now our standard Julia option called high-grow, that first scenario, very good inflation protection. Even when inflation doubles, still very good protection. This is assuming that investment returns move up with that, which is what you would expect. And then finally, even for blowout inflation levels, you'd expect very good protection. However, as we mentioned, starting income for those not looking so attractive at the moment. Finally, high-grow advance option. At the expected range of inflation levels, still good protection. Even if inflation were to double, and as I mentioned, investment returns move along with that in pace, still very good protection. However, for blowout inflation scenarios, there you could say that the advance feature would limit the protection against inflation because those increases are capped. However, and this was what we mentioned with the risk-reward dilemma, the reward here is that you get a higher starting income to recompensate you for that. So in conclusion, the South African retirement income market landscape is evolving, with good solutions for clients depending on their needs and situation. The Just Retirement Insight survey showed that the core client needs remained income for life, which offers inflation protection. Income sustainability maps show that 68% of living annuitants are drawing down above safe rates. Blending, which is the combination of a life and living annuity, fills the gap where 100% in either a living or life annuity is not optimal. Investment-linked annuities offer great protection, but currently low starting income. But an advanced feature has been developed to address this new risk-return dilemma.